Hey guys, I'm going to teach you everything that I know in this video, starting with calls, then puts, then butterflies and small account strategies.
What's up, you guys? My name's Henry. If you're new, I'm starting a series on options because that's my area of expertise when I was working at Goldman Sachs. And in this video, I'm going to explain to you what are call options, why they are important, how they work, and the benefits, so make sure you stick with me. Before I jump in and flood your pockets with money, make sure you like the smash button for Uncle Henry and subscribe to the dopest YouTube channel. I'm going to start off by explaining buying call options, and in the next video, I'm going to cover selling call options. So first of all, an option is an agreement between two people. Buying a call option is betting on a stock rising, so a call option is just a contract that allows the buyer to purchase 100 shares of stock at the call option's strike price. So a call option is used to buy stock, specifically 100 shares. But what is a strike price? A strike price is the price which you are betting on the stock reaching, or in other words, a strike price is the price at which the option can be converted into shares of the stock if it is being exercised. And if it's above the strike price, you will be exercising because it makes a lot of sense. Exercise, besides sounding like we're going to be lifting some weights or jogging, refers to the action of converting the option contract into shares of the stock. Let me do an example on the whiteboard so you can see how this actually works visually, since we learn visually and I specifically learn with examples. All right, so I drew this example on the board right here. Basically, we have a stock which is $100, okay? And then we have a call option with a strike price of $110. The reason we're buying call option is because we think that the stock is going to go above $110. So this stock, if it reaches above $110, gives us the opportunity, the right to actually buy the stock at $110. What happens below $110 is, well, we don't have the right. We're not gonna actually exercise because we are not making money. At $110, we are at the money, or we're beginning to make money. So essentially, when a stock rises to 110 or above, the point of a call option is we buy the call option and we bet on this strike price. Here's why this is important. Buying a stock that is $100 costs $100. Buying an option betting on a stock going to 110 may cost something like $2. So instead of spending $100, you can control 100 shares of stock by buying a call option that is like $2 or something very inexpensive. $2 versus $100, you have much more leverage and you control the same amount of shares. So Henry, you're telling me that I can control stock for just $2? Well, yes, essentially you can. Just one thing though, since each option represents 100 shares, if an option is worth $2, that really means it's worth $200. And since it is 100 shares, that means $200 can control $10,000 worth of money. Where am I getting $10,000 from? Well, 100 shares times $100 is $10,000. So in this scenario, to have 100 shares of stock, it's $10,000. Here, to control 100 shares of stock, betting on it going to $110 is $200. That's literally a 50 difference. I mean, it's 50 times cheaper to be buying call options versus owning stocks outright. Of course, I will get into the negatives. There is some negatives and risks, but let's keep going here. So the main element about buying call options, which attracts so many people, is important to understand for you, is that one call option is always going to be less expensive than owning the equivalent of 100 shares of a stock, because call options are just always going to be cheaper and they're going to have leverage. They're going to allow you to control 100 shares for a lower price. Now, what we do have to talk about here is that there's going to be a premium on the option. Options are not free, so you don't get to just bet 110 strike without paying some type of premium. So we're going to go over an example of paying a premium, and we're actually going to pull up a real life example of Apple stock. We're going to be looking at Apple call options, and I'm going to show you exactly what a call option on Apple looks like versus just owning outright shares of Apple by itself without having the call option. All right, guys, so check it out. I'm looking at my screen right now, and basically we have an Apple call option here. As you can see, it's a 120 strike, and we can pay $207 to buy basically the rights to 100 shares of the stock. I'm going to explain to you exactly what this means and what the break even is, because it's important to know what you're paying for and what your outcome is going to be. I'm going to explain that right now. So basically, if you're going to buy 100 shares of Apple stock right now, it's at $118.72 right now. So if you're going to buy 100 shares, you're going to have to pay this amount right here, $118.72. And because we're buying 100 shares, we're going to put 2 decimal points over. There we go. $11,872 is what you will have to do to buy Apple stock right now, 100 shares, okay? Now with the call option, we're gonna be betting at 120 strike, okay guys? And this costs right here, $207. Notice here that it says break even of 122.07. The reason it's a break even is because we're adding the strike price, which is $120, plus our premium. So our break even is 122, okay? 122.07. Once the stock reaches this price right here, everything above it is yours. Call options have unlimited upside potential. They continue to go up because it's essentially similar to owning shares, but you have that initial break even point where you have to pay a premium, plus you're betting on a strike price higher than the current strike price. Essentially, I can draw you guys a graph right now. All right, so essentially we have Apple, right? So let's say this is 118, okay? 118.72, okay? Here's Apple stock. It goes up and down, right? As the price here, this is the price, okay? We've made $0. If Apple goes up 10 bucks to this area right here, you earn 10 times 100, which is $1,000, okay? You can earn $1,000 when Apple goes to, this is going to be 128.72, okay? That's Apple stock. It's pretty simple, right? It goes up $1, you make $100 because you have 100 shares. Now let's talk about the call option. With the call option, we talked about having a strike price of $120. So we need to go to at least 120 to start making money. Now, we also have to pay $200, $207, but let's just call it $200, okay? With the call option, you start out right here. Right away, you're losing money because you have to pay a premium. So you're paying $200. You start out at negative 200. Notice that your maximum loss is negative $200. You cannot lose more than what you put into a call option. Okay, so here we have a call option. We spent negative $200. And regardless of how low the stock goes, you see a stock investor can go down all the way to negative $118 times 100 shares. You can lose 11 grand here, or over 11 grand. With a call option, you're stuck here. No matter how low you go, you're always at negative 200, okay? And your break even, again guys, it's the strike price plus the premium. So the strike price was 120, okay? And the premium was $2, okay? Our break even is 122. So somewhere here, okay, 122, call it here, is our break even price. What happens is between 120 and 122, it starts to go up. It starts to go towards break even. Boom, we have broken even. And now you have unlimited upside, just like the stockholder, and you're going up essentially 1 for 1, okay? Here you are. So let's see what actually happens here is when a stock goes up $10, as a stock investor, you earn $1,000, okay? $1,000. As an option investor, when it goes up 10 bucks, okay? This right here, 128.72, we'll just call it 128. 128 minus 122, that is going to be $6, guys. So $6 you make, okay, I'm gonna draw it right here. You make $6 as an option investor and you make $10 as a stock investor, okay? So who made more money? Well, the stock investor made 10 bucks and the option investor made $6. But how much did the option investor invest? And by the way, since it's 100 shares, this is actually $600 and this is actually $1,000, okay? This is $1,000 and that's 600 because again, each option contract is worth 100 shares of stock. So, you know, the stock investor made $1,000, but how much did he have to put in? He had to put in $11,000. How much did the option investor have to put in? He put in $200 and got $600. So you can triple your money as a call option buyer. You can absolutely triple your money. And even more, it can go unlimited. It can keep going. But essentially, I'm trying to paint you guys an example that buying calls, you have a little bit of an initial break-even price. It has to go up by the amounts of premium that you pay plus the strike price. You can play around with the strike price. That's beyond the scope of this video. But essentially, a call option gives you the rights to buy 100 shares of stock. You can leverage your money because you put in so little and you can get out so much. And this is a better way than just owning stock outright in many scenarios. However, we do have to talk about risks. I'm about to get into that right now. Okay, now that you have seen why call options can be so lucrative, I need to explain what expiration means. Expiration, like the old milk in your fridge, is when the contract expires. It is no longer valid. Either as a buyer, you made money or you lost what you paid for the option, which is called the premium, which I just mentioned. Now, the good news and a big benefit to the call buyer is that they can only lose what they paid in to the option. In the case of an Apple call option, as you can see on my screen, you can only lose $207. When you buy calls, your maximum loss is just a premium, whereas if you own 100 shares of Apple stock at the current price of $119, you can lose $11,900. Of course, Apple isn't likely to go to zero. So I'm gonna go to Yahoo Finance, and I'm gonna pull up the Apple chart just so I can do some technical analysis for you guys and show you what I look for when I'm selling a put. So here I am, I'm in the charting feature, and I'm actually gonna get rid of this Bollinger average. I'm gonna show you guys what Bollinger average means in just a second. So the first thing that I wanna do is I wanna take a moving average of Apple and see where it has been trading for the past maybe 30 days. So for this period, instead of 50, which is the preset for Yahoo Finance, I'm gonna put 30 instead. Now I have a line here that shows me the average price that Apple has been trading at for the last 30 days. As you can see, Apple is trading below the 30-day moving average. Now I'm going to go over and I'm going to go into indicators and I'm going to click Bollinger Bands. And Bollinger Bands are just a simple way for me to understand where Apple is going to trade in terms of its high point and its low point in terms of its standard deviation. All that really means is where Apple is likely to be traded based on this indicator. So after I use this indicator, you can see that Apple is near its low of the Bollinger Band. Now I also look at RSI, you can see here that it's 46, which means to me that Apple is somewhere in the middle of its trading range. It's neither oversold nor is it overbought. Now I see Apple had a lot of consolidation around the 119 level. So one time it was at 119, another time it was at 120. Again, it was around 119.99. So I see there's a lot of support for Apple right at the 120 level. Now I'm going to go back to Robinhood, and what I'm going to do here is I'm going to click Trade Apple Options. Now Apple is $128 per share, and what I'm going to do here is I'm going to go to Sell Put, because this is what the video is about. I'm going to show you guys exactly why I sell puts and what level I do it at. So this week is May 14th. However, I want to go out at least 1 month so I can capture a decent amount of premium and not have to trade weekly with this single trade. However, I'll show you more weekly trading in the next stock that I pick. But for Apple, it's a little bit less volatile, meaning that you don't really want to do weekly options because they're not going to have as much premium as a monthly option will have. So what I'm going to do here is I'm actually going to go out 1 month and go for June 18th. And now I'm going to take a look at the option chain. So this is what an option chain is. It gives you the strike price, it gives you the break even, it gives you the chance of profit, and it gives you so much more information. Now, I did tell you guys that the 120 level has a lot of safety and a lot of support around it. So for me, this looks pretty good. However, if you take a look at the premium, $1.51, or as I've said earlier, it's gonna be $151 because it is 100 shares. Actually, this is a decent return. It's just slightly over 1%, but in a month, I wanna make a little bit over 1%. So for me, the 120 level is just not risky enough. Also, if you take a look at the 122.5 strike, you can see here the break even is actually $120.41. That's because when you take the strike price and you subtract the premium that you collect, your actual break even price would be $120.40 because of that premium that you collect. For me, this is a much more safe trade. However, it does have some decent premium and I do want to have this in my portfolio. So this is a great example for me to show you guys. So what I'm going to be doing right now is I'm actually going to click this little plus sign right here, which tells Robinhood that I want to sell this put option. You guys can see now that it says short put. Now, all you really have to do is click continue, and I'm going to enter the amount of contracts that I want to trade. For me, I want to enter 3 contracts because I have a decent amount of money sitting around and I want to execute 3 contracts. So here I go, I click 3 and I'm going to put the bid price, which is $2.08. So $2.08 is the bid price and $2.11 is going to be the ask price. Since I'm selling this option, I'm going to go for the bid price, $2.10. I'm going to review this trade real fast. And Robinhood is asking me, are you sure you want to buy 300 shares of Apple at $122.50? Notice they're saying that because when you sell a put option, you're committing yourself to buy the stock at the strike price. So Robinhood knows this and they're asking me, are you willing to purchase the stock at that price? And since I just showed you guys that on the technical chart, I would be happy to own Apple at an average price of about $120. I'm happy to place this trade. This trade takes up $36,000 of my capital. So there you go, guys. I just collected $636 for the first trade. All right, now let's find the next stock that I want to trade on. Today, I'm going to be talking about some strategies that can turn $70 into $430 or even $700 into $4,300. So yes, I'm going to basically talk about how to 6x your money with a small portfolio. I'm going to be discussing 3 different strategies that I want to share with you today, and I think you're going to really like what I have for you. Also, make sure to check out the free email newsletter that I have in the description. I usually give free weekly value over there, and it also doesn't hurt to hit that like button and subscribe. Now, something important I'm going to discuss is closing positions, because a lot of students have asked me about closing positions, when to do it. So we're also going to discuss setting stop losses. It's very important to risk management, and it's also very important if you want to be a profitable trader. So people think that you need a large portfolio to make a lot of money, and I want to debunk that myth because it's actually just not true. You can actually turn a smaller portfolio into a medium and a larger portfolio. It just takes skill, knowledge, taking proper risk, managing your losses, and of course risk management. And the combination of these things will allow you to grow a small portfolio, because it's not like you have to have a 7-figure portfolio like me to see some good returns. I'm going to be showing you a few different trades on 3 different stocks that I think is a very good trade. And in fact, I would place that trade if the market weren't closed right now, but as soon as the market opens up, I'm actually going to be making these plays. All right, so the first thing that I want to show you guys is I'm going to open up AAL. And the reason why I want to open up American Airlines is because the strategies that I'm going to be using today, well, one of the assumptions is that the stocks are not going to tremendously shoot up or fall. Basically, our assumption is that a stock is going to continue to go sideways. In fact, all 3 strategies that I have today is going to consider that a stock is going to go sideways, because part of that reason is I think the market is high, but I also don't see any catalyst for it to fall any lower. So I think the market will trend sideways. But anyways, you can pick your own stocks. This is just me showing you what I'm going to be doing and my thought process. You don't have to copy this. By no means am I a financial advisor. Just go ahead and learn everything that you can, and then apply this knowledge to your own stocks and your own watch list. So taking a look at American Airlines, it has had some volatility. However, what I've noticed is as soon as it jumps up, it always tends to fall back down. In fact, if I go to 6-month chart, it pretty much hasn't gone anywhere in the past 6 months. I mean, sure, it did start off around $25, but if you take a look right over here, I'm going to scroll down right now, around July 19th, this stock is still trading where it's been on July 19th. So for the past 4 months, this stock has gone up, down, up, down. It's pretty much traded sideways, gone up, and then back down, up, and then back down. And I kind of understand that this pattern is going to continue with American Airlines. I don't see any reason that it's going to fall too much lower. I don't see any reason why it's going to jump back up in the next couple of days. So for this week, I'm going to show you a strategy that is basically going to turn about $70 into $430. I'm going to open up that position in Robinhood, but real quick, as you guys can see, every time it jumps back up, it trends down, and then it'll go sideways for pretty much a week. So this is about a week. This is about a couple week period right here. This is from the 16th, and this is going back to the 16th. So this is an entire month where American Airlines has traded sideways. Essentially, that is the thesis for American Airlines. That's where I'm going to be starting here. I'm going to go to Trade American Airlines Options, AAL Options. Now, you can pick any date that you really want. I typically like to go for weekly options or bi-weekly options. The reason why I like to go for weekly options is because not a whole lot of stuff can happen in a given week. I mean, unless there's an event like maybe earnings or there's a Fed meeting, then there's usually not a whole lot of events that can turn an option upside down. And if the option doesn't go in my favor, I can always set a stop loss. I can always close the position. And it's much easier to monitor a position in a given week than have a option that is out for a month or 3 months. That longer term time period is just harder to trade because it's easier to bet on a stock going sideways in a given week than for a stock to go sideways in a whole month or a whole 3-month period. So now I'm going to look at the option chain. And again, as an option trader, my assumption here is that the stock will move sideways. So the first thing that I'm going to do is I'm going to sell a call option that is near the money. So right now, American Airlines is $19.53. I'm going to sell the 19.5 strike, and that's basically at the money. It's only 3 cents off. So I'm going to click right here. It's going to be worth $30, and I'm going to click sell. This is going to be $30. And now what I'm going to do, this is very important. I'm going to go buy a call option. You guys will see I'm going to enter a custom order. So this option strategy is going to be a custom order, and you're going to see on the right side right over here the exact payoff, the risk that I'm taking, and the profit that I'm going after. Okay, going for buy call option, I'm going to buy a leg above and a leg below. This is going to be important when you guys see this strategy actually play out. Getting started here, 19 strike. This is the leg below the 19.5 that we have open. So I'm going to open up this call option right here. This is going to be a buy. Now I'm also going to buy the 20 call option right here. Now, if you notice, the cost is 42, but what I'm going to do is right here where you see this custom order, there's a little drop down menu here, and I'm going to go to custom. Rather than a 1-to-1 ratio, I actually don't want to open up 1-1-1. I'm actually going to go ahead and sell two 19.5s. Going to the custom, clicking right here, going right here where it says 19.5, the option that I have sold, I basically want two of these sell orders to account for this 1 and 1 buy order. All right, cool. Now that we have entered that, I'm going to scroll down and you guys can see that this is a very beautiful chart, and I'm going to explain it right now. The max loss right here is $12. However, your max profit is $38. So as you guys can see in this example right here, you can triple your money.